Okay, let's talk about corporations and the corporate form of organization. So a corporation is a separate legal entity created by law. Its existence is going to be separate from its owner. So if the owners happen to die or move on, the corporation can still continue. And a corporation has certain rights and privileges. So a corporation can be either privately held or publicly held. Publicly held companies you're probably more familiar with. Those are going to be ones traded, say for example, on a stock exchange. Examples would be Walmart, Google, Apple, Home Depot. And then there's privately held companies. These are only, stock is only issued to a certain group. They call them closely held organizations. So perhaps current employees or people who are directly tied with the business. Now those are not traded on a stock exchange, so you have to know someone or work there to get stock in that particular company. Let me just go back up. One of the biggest privately held companies that I know of is Menards, which is similar to Home Depot in Lowe's. They're out of the Midwest. They're actually large enough that they have their own NASCAR car that races regularly. Paul Menard drives that car, so they're pretty big, but you would have to be an employee or one of the Menard family members to get stock in that company. So advantages of a corporation, it is that separate legal entity. So, and there's limited liability of the stockholders. If I want to buy stock in Home Depot, the only amount that I will lose will be my investment. So I don't have any liability back on me if something happens with that company. Now it's transferable ownership rights. So again, if I buy Home Depot stock, I decide I don't want it anymore, then I can sell it or give it away to someone else. There's a continuous life, that advantage. Remember, a corporation continues on in perpetuity until it's dissolved. Stockholders are not corporate agents, so even if I did own some Home Depot stock, I can't go out and enter into a contract on their behalf. And then ease of capital accumulation. So it's a good way for companies to raise money. All they have to do is convince you to give them money in exchange for ownership in the company. Now the big disadvantages are going to be the double taxation. So the corporation is going to be taxed. And then when they share those earnings with their stockholders, the stockholders are also taxed. So that is a huge disadvantage to a corporation. And there's some increased governmental regulation. If you're a publicly held company, you now fall under Sarbanes-Oxley. So there's some reporting issues there. You have to have annual meetings of the board of directors and some other logistical items there. So the basic corporate form of an organization starts with the stockholders. The stockholders elect the board of directors, who elect the president and who hires the vice presidents of the company. So technically the board of directors maintain the overall responsibility for managing the company. Now often a vice president and a president will sit on the board of directors, which I think maybe makes this oversight not as good as it should be in some cases. And again, the stockholders elect those people that are on the board of directors. Now the stockholders usually hold a meeting once a year, and technically they're supposed to have ultimate control because they do elect the board and the president. Now the problem is you get some super mega large companies out there, and for example, even if I own 1,000 shares of Home Depot stock, if they have 15 billion shares outstanding, I really have no control over how that organization is being run. But if you are a majority stockholder, you would certainly have some control. Now if you do own stock in a company, there are a couple of benefits that you get. One is going to be that you can vote in the election of the board of directors. There's also other kinds of special actions that they will often have you vote on, like if they want to buy out another company. You get a share through the share in the corporate earnings through the receipt of dividends. So again, if the company's making money, they can choose to share that back with their stockholders to keep them happy in the form of a dividend payment. There's something called preemptive right that stockholders get. So if you had a 14% ownership and they go out and they issue another 100,000 shares, you have the right to buy enough shares to maintain your 14% ownership. And then as a stockholder, you also get to share in the assets upon liquidation. So if the company goes out of business, after the lenders and creditors are paid, then the stockholders gets what's left over. However, usually there's not enough. Otherwise the company wouldn't be going out of business. So there's two different basic classes of stock. One is called common stock. This is the most common form. And the other is going to be preferred stock. So there's certain advantages to owning preferred stock over common stock. Typically, they get dividends before common stockholders do. So if there's only a finite pool of money to give out, preferred stockholders will get paid first. And then they also get priority upon liquidation. So if the company goes out of business, preferred stockholders get their money back first, I guess. Other stock considerations are something called authorized stock. So this is the amount of stock that a company is authorized to sell in its charter. There's no accounting entry associated with that. So let me show you what a typical stockholders' equity section of a company might look like. You'll see here common stock. There's an associated par value. We'll talk about in a minute. A penny. Authorized 250 million shares, and then this is what's issued. So this particular company is authorized to issue up to 250 million shares. And then you can see what is actually issued to those stockholders. Now let's talk a little bit about par value stock. So it's been assigned a par value in the corporate charter. So when they actually create the company, they set up this par value, and it represents the legal capital per share that must be retained in the business for protection of corporate creditors, or at least I think in the past that was the thought. And there's also no par stock, so it's not been issued or assigned any value in the corporate charter. Now something else, a lot of states allow the board of directors to assign a stated value, which acts just like par value. And then depending on whether we have par value, stated value, or no par stock, that's going to impact how we handle our journal entries when we do that stock issuance. So again, par value, it's just an arbitrary amount that they set aside when a company stock is issued. And it doesn't correlate in any way to market price, the amount that it's going to sell for. Okay, so if we have par value, when we issue the stock, we will credit common stock at par value. And if we have no par value at the stated value, we will issue it at the stated value. However, if we have no par value stock and there's no stated value attached, then the entire proceeds are going to get credited to common stock. And you'll see here in just a few minutes what those journal entries look like. A couple other quick components of the stockholders' equity section in corporation's balance sheet. You should have known by now that we have common stock and retained earnings as our primary components to stockholders' equity. There's something else here called paid-in capital, or you may see it as contributed capital. This is going to be the total amount of cash and other assets paid to the company in exchange for capital stock over and above par or stated value. So when we are doing our accounting, we want to be able to identify the specific sources of this contributed capital or paid-in capital, and to maintain a distinction between it and our retained earnings. Remember, retained earnings are like the savings account that a company has. So any monies that it makes in the business over and above what it pays out in expenses will get moved over into retained earnings. So here's an example when the issue price is the same as the par value of the stock. So Hydroslide issued 1,000 shares of $1 par value common stock at par for cash. So we just debit cash for the amount we collect, which is the 1,000 shares times the $1 par value. And we credit common stock for the entire amount as well, $1,000. Now, if the par value and is not the same as the issue price, let's look at what happens. So now we issue 1,000 shares of $1 par value common stock at $5 per share. Okay, so this time what you're going to see is we received $5 for 1,000 shares. So that's going to be $5,000 debit. We're going to credit credit common stock at par value. So that's $1 par value times 1,000 shares. And then the difference is going to go to this account called paid-in capital in excess of par value. So it's very descriptive. It's the amount of money we receive in excess of our par value. So now my debits here are going to equal my credits. Both equal $5,000. And here's what happens on our balance sheet for that particular transaction. So you'll see we have common stock at those past two transactions. Common stock at $2,000. We'll see paid-in capital in excess of par value 4. So my total paid-in capital, that's monies contributed to me by my stockholders, is $6,000. Retained earnings at 27 for total stockholders equity of 33. Now what happens if we issue no par common stock but it has a stated value? This stated value is going to work just like par. Oops. So stated value works like par value. And in this case, that instead of issuing $1 par value stock, Hydroslide has a $5 stated value no par stock, and the company issues 5,000 shares at $8 per share. Okay, so in this case, we're still going to debit cash for the amount we collect, which is $5,000, or 5,000 shares, I'm sorry, times $8, that's 40,000. We're going to credit common stock at stated value, so that's 5,000 shares times $5 stated value, or $25. And then the difference again here is going to be $15,000. That's the 40,000 minus the 25. So cash proceeds minus the stated value, or par value. Now what if there is no stated value and it's no par? If that's the case, then the entire proceeds get credited to common stock. So here we issue 5,000 shares at $8 per share. So cash will be debited for the 5,000 shares times the $8 per share, and it's also going to be credited for the same amount. If there's no par or no stated value, the entire proceeds get credited to common stock. Now just one other thing here too. People don't have to give you cash in exchange for stock. Perhaps you're a new business and you say, well, if you give me some legal services or you give me some equipment, I'll give you stock in exchange for that investment. And the way we want to handle that is that we're going to determine the cost as being either the fair market value of the consideration given up or the consideration received, whichever is more clearly determinable. So let me give you a quick example. Athletic Research Inc. is a publicly held corporation. Its $5 par value is actively traded at $8 per share. Okay, here's something really important here. You see this actively traded. So, I'm sorry. Actively traded. That's a pretty good determinant of value. The company issues 10,000 shares of stock to acquire land recently advertised for sale at $90,000. And then it goes on to say the most clearly evident value is market value of the consideration given up. The reason is this is actively traded. If any of you have bought any property lately, this is advertised for sale. Sometimes the asking price is really not a very good indicator of actual value. So this is actively traded, meaning there are a lot of people looking at that in a stock exchange, so that's the best, more clearly determinant value. So we're going to go ahead and debit land at $80,000, which was the $8 per share times the 10,000 shares that were issued. And common stock is going to be credited at par value, so $5 times the number of shares, which was 10,000. And then the difference will go to paid in capital in excess of par. Remember too, here we're not debiting cash this time, we're going to debit land. That's what was donated.